Hello, and welcome to Portfolio Matters. This is week 5, a weekly update. And before we go into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Richard. Okay, well, we have a lot to cover this week as well. Very interesting times in the market. Right, so the main news events that I caught my interest were that Republicans came back with an offer of 600 billion stimulus package versus Biden's wish for a 1.9 billion package. And according to the FT, Biden is planning to go it alone. So
which he can do, can't he, because of the balance?
Absolutely. If he can get all the Democrats to toe the line, he can push this through.
Yeah.
So, I mean, we don't know, but obviously 1.9 billion stimulus is very good for markets. And the other thing is the Bank of England has ruled out negative interest rates in the near future. So you will have seen that interest rates went up, UK rates went up yesterday, and the banks have had a good day. And we will go into this further in as we go through.
I think it's interesting that they have ruled out negative interest rates. I think was it over the next 6 months? I think they said.
Yes.
Right? Because why would anyone need to rule out negative interest rates? One asks, and I suspect the very fact that they've ruled it out in the near future means that they are seriously considering it.
Well, they had seriously considered it. That they had put out a policy paper and consulted on it.
Right.
And of course, various countries have had negative interest rates. Obviously, the EU has very negative interest rates across the curve. But what they've said is banks would need at least 6 months to prepare for negative interest rates. And so they pushed it down the road for at least 6 months. And as long as we get a recovery, you'd hope that threat would go away, because negative interest rates are incredibly bad for banks.
Yes, we'll see.
Okay, so big news of the week. GameStop came back down to earth. So the Reddit Wall Street Bets crowd have had their fun. And in the course of 2 weeks, they've pushed GameStop from under $40 to over $480, and now it's back down again. And in that round trip, you would hope that most people got out towards the highs, because otherwise, anyone who got in during the ride will have lost money.
Of course, Keith, they can't all have got out at the highs because they've sold to someone.
Precisely, that's exactly right.
So there's been a large wash of money from one place to another.
Exactly. And their attempted squeeze in silver has failed for now. But as we covered and Richard has talked about previously, we are bullish on silver long term, and silver is actually picking up again this morning.
So, Keith, I read an interesting article this morning about the silver squeeze, which basically suggested that it wasn't initiated by the Reddit crowd, in inverted commas, but was effectively initiated by sophisticated traders with a great interest in pumping the price up and then watching it drop back down again. But taking advantage of the sort of Reddit frenzy, which I thought quite an interesting theory. And effectively what's happened is silver hasn't moved very much from this time last week to now.
Yes. Very true. Yeah.
But someone has shifted a lot of money in between.
Yeah, that's true. And it's also true that hedge funds made a lot of money out of GameStop. Although obviously the ones that are short lost vast amounts. But people who are long, you will have seen that one of them used the signal of Elon Musk tweeting about GameStop as an exit strategy and sold the moment they saw Elon Musk was tweeting about it, which proved to be the high, and they made a vast amount of money. Okay, so gold had a bad week, and frankly, I've had a bad week, partly on the back of gold. And gold, it has crossed its 200-day moving average, which is generally seen as a bad sign. And actually, one of the few technical indicators I look at is the 60-day versus the 200-day moving average. And generally, you can see if you sell when the blue line, the 60-day, crosses the 200-day, which is the green line, and then buy when it crosses back, that's proved to be an okay strategy. So I have actually reduced my holdings in gold. I've sold down to the sleeping point, as Jesse Livermore would say. Now, I thought this was very interesting. So this shows the impact on very low interest rates on household spending. And you'll see that, so household spending is on the y-axis and interest rates are on the x-axis. And so as you reduce interest rates from 16% downwards, then household spending goes up. So people are spending less on their mortgages and have more disposable income. But then you reach this inflection point at about 4%. And as interest rates go down from there, actually people spend less, presumably because they have no return on their savings and they have to save more. So obviously now we're in 1%, 0.1% territory. So people's spending is depressed. And this is historical interest rates going back to 1317.
Right.
And these are real rates. Okay, so you see in both the wars, interest rates were suppressed while inflation ripped higher, and you got up. But again, following on from our discussion last week, I'd say this chart is strongly mean reverting.
I would also say it's possibly meaningless because economic conditions change so much, and in fact, it's very, very noisy, isn't it?
It is. No, absolutely. And for the vast majority of this chart, there was a solid metal standard, so it's either gold and silver or gold. And now, obviously, it is just pure fiat currency, which is worth nothing but your trust in it.
Yeah.
Okay, so the other thing is, Richard and I are very keen on the clean energy revolution, and this table looks at what metals will be needed for Tesla to get to its 20 million cars a year target, and what that metal requirement is compared to production in 2019. So you see, they're going to need more graphite than is currently produced, 31% of all nickel production, 165% of all lithium production, 9% of copper. They've got manganese situation is absolutely fine. They're going to need 56% of all cobalt. Aluminium production is fine, and they're going to need 40% of all neodymium.
And of course, what you can do is you can cross out Tesla, and you can say metals needed to build 20 million electric vehicles a year.
Exactly.
And basically, the numbers don't change very much using lithium batteries.
Yes, precisely. And actually, you'd have to add to this, Volkswagen, where all these other car manufacturers. Essentially, what this is saying is they're not going to be able to do it without massively ramping up the production of lithium, graphite, and cobalt, and neodymium.
That's very interesting, Keith. It reminds me that I've just added, actually, I did buy a graphite producer this week.
Ah,
I shall
right.
tell you all about in a minute. Well,
Excellent.
conventional.
I look forward to it. And the Reddit crowd have had a real impact on the market. So if you look at the relative performance of the most shorted shares in the US market, the most shorted shares have actually outperformed the rest by an enormous amount. Now, previously, when I was talking about my disastrous trade, Asian citrus, where the short sellers were very negative and a huge short position. And I was saying that you had to listen to the short sellers. Well, currently it's the other way around. I mean, short sellers are seen as fair game for a short squeeze. And so the Reddit crowd is searching out short positions and then squeezing the share price much higher.
And right now, I suspect that various hedge funds that have large short positions may be gently getting out of them.
Well, absolutely.
That's what I'd be doing. But maybe I don't run a hedge fund, so that's perhaps why.
Now, I thought this was possibly the most important chart this week. International freight rates have absolutely exploded. So international trade is coming back, and there's a shortage of containers. So freight rates have gone through the roof. And so we're seeing inflation absolutely everywhere. You know, this is going to feed through to the price of all imported goods. Okay, so onto the checklist. Well, equity markets had a good week. FTSE up 1.1%, S&P up 2.2%, NASDAQ up 3.3%, Topix up 2.8%, Bitcoin up 4.5%. That is an enormous annualized return. I'll leave it to Richard to talk about that in his segment. I have rearranged the weekly checklist a bit to include industrial commodities and precious metals, both of which I think are on our radar screen.
Yep.
And you can see that copper has stabilized at its recent highs. Iron ore was down slightly again. Lithium had a great week, which Richard will be going into. And WTI, oil, had a great week. Despite that, my oil companies had a terrible week. Gold had a poor week. And as we covered, it has now crossed its 200-day moving average on the downside, and I trimmed my position. Silver and platinum, in contrast, had good weeks. And I hope you've all watched our platinum special, which shows that platinum has actually relatively underperformed and is in a supply deficit.
And also the interesting report on Sylvania,
Yes,
which you should watch before making up your mind as to whether you should buy it or not.
absolutely. Okay, so this is platinum over the course of the last year. And now that is a nice upward trend, I'd say.
Yeah.
And this is platinum over the course of the last 25 years. So
interesting. If you draw the line from the peak in 2008 to the little peak in January 2020, you get a straight line there that it is now broken out of.
Good spot, Richard.
Pattern recognition is my forte, Keith.
Yeah. So we are on the stock market seasonality. We are at the beginning of February, where things are picking up a bit, which I think actually we've seen. So what's happened with rates? Well, the UK ruling out negative interest rates has been very good for interest rates rising. So bad for bonds, good for rates. And as you'll see, the UK 30-year has crept up above 1%. And what this now is showing you is we have a duration yield. The gap between base rates of 0.1% and the 30-year is now plus 0.9%. And that is good for banks.
Yeah.
Rising differential between short-term and long-term rates means that banks actually have a profit margin. So I have bought some Lloyds as a tester, and going forwards, if you think the UK economy is now going to recover and the banks are not going to be hobbled by bad debts, then they should be a good investment because they are geared to the economic cycle. Okay, shall we move on to our portfolios? Richard, would you like to go?
Yep, let's do that, Keith. Let me share my screen.
Sorry.
So last week I was actually up 5.4%, which effectively took back my very poor performance the week before.
Yes.
The reason being, actually, whilst the pop in silver effectively sent my silver shares up very significantly, I had several going up 20 or 30%. When it dropped back down to the level it is now, they didn't retrace all of their gains. So I've actually, over the weeks, some of my silver mining shares have taken a reasonable gain, and that's the result. That's the cause of that change, effectively. Also, since our last recording last Friday, cryptocurrencies have improved, and talk about that in a minute. So trade's done. I repurchased Altisource Portfolio Solutions. This is Altisource Portfolio Solutions, and Keith very kindly pointed this share out to me, I think in about February or March 2020. And what it does, it basically assists lenders in resolving issues relating to default on a lending, and particularly to homeowners. And if you look here at the weekly graph, the shares peaked. They're a US share, and they peaked at about, I don't know, 17,000, and that's probably 1,770, isn't it? And that was due to the wave of defaults in the US following on from the 2008 crisis. So, and from that point onwards, presumably they became very unbusy, and their profitability declined, and the share price declined tenfold. And then for the last 5 years, they've been doing very, very little. And then if you look at the daily chart, they took their big hit in March 2020, and at which point it felt like there were an awful lot of homeowners who were going to go into default, and portfolio, and Altisource would derive a great benefit from that. But in fact, of course, the US government stepped in at that point and said, we're not going to have any evictions, you can't, we'll fund defaults and so forth. So in actual fact, their call for their services never materialized. And since that point, they had to pop up, and they've effectively been moving in a range. So, but at some point when the economy picks up, the US government is going to have to step away from that position, and homeowners who are in default will have to go through the default process. Otherwise, the whole banking system simply fails to work. It becomes a command and control system, which I don't think is going to happen, which does mean that Altisource at some point should get very busy. So it bounced a little bit the other day from about 1,000, and I just thought this was probably an opportune moment to try again. And I think the key point is it probably needs to get above 1,500 as to sort of indicate that it's on the move.
Well, I have held it for throughout this period, essentially. So I came across this share in late 2020, sorry, 2019.
Yeah.
And frankly, as the COVID crisis developed, you would think that all this economic disruption would be incredibly good for Altisource, because people would be unable to pay their mortgages. So there'd be a lot of call on its services. But actually it did the opposite. Its share price started falling heavily. So I sold it, and I bought back in March, and I've held it since then. Now, the bear case, well, No, actually, Richard, I'm about neutral because I bought more at the top.
Well done,
And
Richard, well done, I'm sure.
yeah, well, and the bear case is that there's a lot of support for homeowners in default, and that evictions, etc., won't pick up in the US. But the thing is, if you look at the mortgage arrears, there are lots of people in mortgage arrears. And going forward, you can't keep all these people in their homes, because as soon all the people who are actually paying their mortgages, if they discover that actually you cannot pay your mortgage and just keep your home, then the whole business is undermined.
Yeah.
So I'm expecting default rates to pick up medium term.
It's really a question of timing, and the timing is dependent on the US government policy, isn't it, Keith?
Yeah.
So just going back then, I bought shares in a company called Leading Edge Materials, which owns a graphite mine.
Ooh.
Now, it's in Europe, and maybe we should do a special on it, actually, thinking about it.
Well, that'd be great.
It's particularly interesting given that 20 million electric vehicles requires 95% of current graphite production. So I bought a small position in that this week. And
So, Richard, is it a producer or is it an explorer? Does it actually have producing mine?
It has a producing mine, Keith.
Excellent. Oh, I'm interested.
But I will. I'll prepare a note on it.
Great.
Presentation on it. So I thought. So Keith mentioned lithium. This is the graph of lithium carbonate, and I put in the 2 previous weeks because I think it's quite interesting to show the 2 graphs. But obviously, it is on looks like it's on a fairly firm upward trend now. And
yeah.
I then compare it to Zinnwald, as I did last week, which is my lithium miner. And Zinnwald is like just sitting there saying, I don't really care that the price of lithium is moving up. I'm going to stay where I am at 13. Thank you very much.
Oh, that's interesting. So a gap is opening up between the price of the underlying and the price of the share.
Yeah. So just sitting there, fully anticipating that the price of Zinnwald may go up. Hoping at any rate.
Yeah.
So I came across this graph this week, Keith. The US private investment in mining exploration from 1958 until now. You can see that has been a continuing downtrend. And I think this is all part of the support of the thesis that we are going to have a commodity price rise. If you cast your mind back to the mining clock that Keith showed, I think in one of our very first episodes. This is a classic example of low levels of investment because of low level returns, ultimately resulting in shortages. And I think we are heading to the point where we have shortages and investment will start to increase, but the shortages will result in a significantly increasing price in commodities generally. That would be 6 p.m., wouldn't it, Keith, on the mining cycle?
Yes, actually, we should do that. It's the start of a new month. Next week, we should do the dials again.
Yeah. So silver to US M2 money supply, an interesting graph. My view is that silver has got a long way to run, and the price will go up significantly in time. You have to shut out the small movements, the high level of volatility. I thought it was an interesting graph that it's a gold log chart, and so the logarithm of the price of gold. And sometimes when a logarithmic chart can sort of clarify a little bit with what's going on because it shows percentages rather than absolute returns.
Yes.
And there's a certain symmetry to this chart. I'm not saying that it indicates anything, but it does show sort of stepwise percentage movement in the price. So I just thought it was an interesting thing to look at.
Great.
And then this is a graph, Bank of America Global Fund Manager Survey, inflation expectations at an all-time high.
Yes, inflation expectations high, interest rates low.
Yeah.
That is classic time to own gold.
So moving on to cryptocurrencies. So Bitcoin, it peaked back in December. Some would say it's consolidating, others would say it's starting to go, it's preparing for a downtrend, others would say it's going to go up, I don't know. But it has, it's perked up from its sort of lows a couple of weeks ago. I actually, personally, I made a bit of a switch around this time I moved some of my Bitcoin into Ethereum, and it turned out to have been quite lucky.
Well done.
Around about here. Obviously Ethereum is going up more rapidly at the moment than Bitcoin. Now, I came across this graph, Ethereum versus Bitcoin, with a time displacement. So this is when Bitcoin first came on the scene in 2010. Ethereum first came on the scene in 2015 or so. And what this graph is doing is a stock to flow graph for both Ethereum and Bitcoin. And you can see that if you take the red Ethereum graph and move it over and superimpose it on the blue, I can't do this, it's too technically difficult for me, but superimpose it on the blue, the shape of the graphs are very similar, and which puts Ethereum at this point on the Bitcoin graph, which, if Ethereum were to follow the Bitcoin curve, would take it on this occasion up to a price of around about $15,000 to $20,000. And this, the rationale for looking at it in this way is to say, well, actually, these two items are valued on the basis of the network effect, i.e. the more users there are, the greater the value of the thing. And the value goes up exponentially with additional users. And Ethereum is following a similar network effect trajectory to Bitcoin, but is 4 or 5 years behind it. So that is the theory behind saying this may be an indicator of where the Ethereum price is going.
Very good.
And that's me done, Keith.
Okay, thank you, Richard.
How about you? What happened in your portfolio this week?
Well, sadly, Richard, it is deeply underperformed yours, mate.
Keith.
So I had a bad week, actually. I had a very annoying week, which we'll go into. So I lost 1.1%, which takes me to minus 2.7% on the year. So I was up 35% last year. So this is not the end of the world. No. But still, it was a frustrating week in several ways. So what did I do? Well, I sold some gold. And as we discussed earlier, gold has underperformed my expectations, is the bottom line, in that real yields are increasingly negative based on inflation expectations. So gold should be doing well, and it's not. So I sold down to the sleeping point, to the point where I had enough of it that I could sleep through a 20% drawdown without panicking and getting out.
Yeah.
And that actually meant I freed up quite a lot of capital. I also sold out of Premier Oil, which is a small, heavily indebted UK oil company that I should never have touched in the first place. And the share price perked up, so I took the opportunity to get out. Okay. And then I sold an underperforming gold miner called Resolute Mining, and its cost of production shot up. It's massively underperformed all my other gold mining shares. So sell your losers. I got out. But then I had a busy week, busy last couple of days, trying to find places for some of this capital. So I bought some oil companies. I bought Jadestone, Parkmead, and Pharos, all of which I only had small positions in. I hold huge positions in Royal Dutch Shell and BP on the expectation of a rising oil price, so I'm not willing to add to those positions. As we discussed earlier, the interest rates are rising, which is good for banks. So at the third attempt, I'm buying some Lloyds. The last two I've closed at losses, and we will see.
Fingers crossed, Keith.
Yeah, and then I bought some Rolls-Royce, which I think we might be getting to the end of this.
Hmm.
And a small amount of hope could see the Rolls-Royce share price flying. So
One of
I bought a bit.
one of the interesting things about Rolls-Royce, Keith, is it does make those small nuclear reactors. Now they're not
Yes.
cheap at $2 billion a pop or whatever,
Yeah.
but they are, in that sense, they are actually a green energy play.
Yes. Well, they produce turbines for everything.
Yeah.
Absolutely, but currently they're not doing well. I mean, they're forecasting that they will burn between $1 and $2 billion this year. And obviously they're crucially dependent on the return of international travel.
Yeah.
But when there's been any indication that the end of quarantines and lockdowns is coming towards the end, then the share prices have flown. I think
the key for Rolls-Royce probably is the reinitiation of mass air transport, isn't it?
Exactly. That's right. Now, the other stock that I would like to talk about is RPS Group, which is an international consultancy. And I bought some of these shares back in March, and I'm up about 50%. But then when I did a screen in Stockopedia and looked at shares which were down more than 50% from their highs and were high in the Stockopedia rankings, RPS came near the top. So I had another look at it and I bought some more. Right. And it's a consultancy which is heavily exposed to oil and gas, hence it's got whacked, but it's also got a growing clean energy business, and it's in lots of different sectors. Right. So it also does defense and public planning, and previously it had been not doing very well, and it was seen as a disparate conglomerate without too much of a coherent plan. Right. But new management came in 3 years ago and they are turning it round. So you'd hope that oil and gas is on the rise, clean energy is secularly growing, and if they can get their turnaround in place, these shares should go back to where their highs, and that is a multi-bagger from where they are now.
Interesting.
So I hope you've all looked at our video on Saga, and I have bought quite a lot of Saga. That is probably my big buy of the week.
Is that in the hope of getting a free holiday, Keith?
No, actually. So going on a cruise is my idea of hell, but a lot of other people like it, Richard. And I hope that they will go on cruises and make me some money.
I'm sure it will.
Tecmar, which is one of our early stock recommendations, has picked up. So it's won 4 contracts in the last month.
Oh, is that why the price has picked up? Absolutely.
So I bought a bit more.
Did you?
And now I have a decent sized position in it.
Well done. Good. I'm afraid my position in it is just the one I bought first off. I haven't bought any more.
Right. Well, I'm very keen on Tecmar.
Are you single-handedly making the price rise, Keith?
Not that keen on it, but hopefully I'm not the only person in the market. But
Keith,
anyway,
Reddit Jordan, as he's known.
Yes. Yes. So this is one of the reasons I'm annoyed this week. So you'll see that in the checklist, oil had a great week and it was up like 4%. In the meantime, BP collapsed and is down 10%.
But I think, isn't that partly because it made such a huge loss along with Shell? Everybody just thought, oh, got to sell this. And isn't it more backward rather than forward looking? Yeah, well, that's true. But also BP has got itself in a mess, and it's trying to reposition itself to be eco-friendly, ESG, clean energy, but they have very little expertise in this. So the market is worried that they're spending money buying in expertise at a premium while neglecting their core business. And currently the market is skeptical about the new strategy, and they have a stretched balance sheet. But I'm very sure that the oil price is going back up, not necessarily this year, but certainly in the next couple of years. And that will be good for BP. So, but in the short term, it is frustrating to see the oil price going up and BP going down 10%.
So anyway, one of the big differences between Richard and my portfolio is I own a lot of oil. And this week it's proved to be a bad strategy. Now, the other stock I wanted to talk about was a little Ecuadorian gold explorer called SolGold. Now, those of you who have watched our video on Sylvania Platinum, I said at the end that I wasn't going to get involved in Sylvania Platinum because my history of buying stocks when they'd gone up in the expectation that they'd continue to rise is very poor. It's always been a disaster. So actually, in the case of SolGold, which has copper gold projects in Ecuador and has actually got one of the licenses to explore Ecuador, which is a neglected region, I bought it way back in March, and then they came out with great drill results. Share price shot up, and at that stage I was up something like 300%, which was great. But then, since then it's been drifting off, and then today it came out with the announcement that actually before it farmed in, so it tried to sell stakes to develop the mines, it needed to do more exploration work, and the share price had collapsed 25%. And frankly, I find these situations very difficult. I mean, in the long term, I think there's a great potential at SolGold, but clearly very volatile.
The thing about these junior explorers is that they're poorly capitalized. A lot of stuff can come along and knock them for six. And my view is, if you want to invest in them, you have to have quite a large portfolio with not very much in any given share. And it's a little bit like, 1 in 10 will make you 50-fold. I'm not saying that's and the other 9 will go bust. Therefore, the investment makes sense, but you've no idea which one's going to do it.
Well, and that is exactly my strategy, Richard. So, I don't own huge amounts of this. Although, when it was up threefold, I did own quite a lot of it. But the trouble is, then you look at Sylvania Platinum, which has gone, up tenfold. You think, well, if you sell these when they've doubled or tripled, then you miss out on the ones that go up tenfold.
Leave a lot on the table, don't you?
Yeah. But when this happens, when you kind of hang on and they bloody well collapse.
Yeah.
So anyway, frustrating.
Damned if you don't, Keith.
Exactly. And I am green with jealousy over Richard's plus 5.4% this week. Although not so green, I'll actually go and buy some Bitcoin. But anyway. So on that note, well done, Richard.
Well, thank you, Keith. But it's these things are all down to fortune. It's just luck, isn't it?
Well, but if you have the positions, you then have the option of selling and closing out at a good profit. So well done. Anyway, so I think that's it for this week. Thank you for listening. I hope you will press like and subscribe to the channel. I am on the lookout for some investments. So if you have any tips, please email us. And we hope to see you again soon. So it's goodbye from Richard. So.
Goodbye from Keith Jordan.
And goodbye from Richard Wheater. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.